All right, we are back. Mr. Michael Zuber is back for another Friday financial wrap up. How are you, Michael?
I'm doing wonderful, back refreshed, and I just want to give you a special shout out. Shout out! You picked up the daily or the weekly financial wrap up and did an amazing job. So thank you, thank you, thank you. Much appreciated.
That means a lot coming from you, man. I appreciate it. So let's get right into it. This is for March the 3rd, 2023. Let's take a look at the week. Rates over 7%. What did you see with the 30-year mortgage rate this week?
Yeah, it's over 7%. It's we got here. I think it was October. It kind of raced up to 7.37, which is the high for like the last year or so. We got down to 5.99 while I was gone on vacation, and now we're back over 7%. So I think we've learned a couple of things about the housing market. These are my opinions, but they are what they are. If we get rates below 6, the market goes bananas. And when I talk about the market, it's first-time home buyers, right? FHA, conventional, right? Luxury is still broken. But first-time home buyers, maybe a little move up. But when rates are below 6, that happens. And if you're a real estate agent watching this, you probably saw an influx of business in late January and early February. That's when rates went down, and mortgage brokers, you did some pre-quals and all of that. Well, now we're over 7. This is the second time we went over 7. And I think what happens here is supply gets constrained. We are operating in such a broken housing market where we have demand constrained at 7% because affordability is terrible. And we have supply constrained at 7% because we have 85% of people locked in below 5%. So there's no supply. So the market is just broken. What does broken mean? It means we probably do 4 million sales versus 6.5 million. So if you're in real estate, you got to realize we're going to do 40% less than a normal year, right? We got used to 6 million sales for a decade. We did 5 million last year. We're going to do 4 million this year. The market's broken. Less real estate agents, right? We saw National Association Realtors say for the first time the last quarter that agents went down. That's okay. That's healthy. There's other jobs out there. But if you're in the real estate business, build your network, understand what's going on, whether you're a buyer or a seller, there's still transactions being done. But yeah, rates over 7%. It happened today. So it's wild to think about how fast rates moved a point a month. It's crazy. It doesn't normally happen that way.
Yeah, it definitely has been a wild ride. And I got to say, you've called it. And it was interesting. I just want to share a note that, I was able to consult a client that otherwise would have been stale. They had a property that was way above the median value. And we happened to, catch that wave of sub 6 and a buyer locking the deal on that Friday where it was sub 6.
Nice.
And that deal's closing with no hiccups. So absolutely an interesting and wild ride for the real estate industry. Let's continue. I'm going to come back also to rates, though, and I'm going to finish with rates because I have a couple of things I wanted to throw at you and get your opinion. Let's continue, though. PCE, what did you see this week in PCE? What are your thoughts there?
Yeah, so PCE, personal consumption expenditures, are one of the 3 inflation gauges we look at every month. It is the one that the Fed looks at, specifically PCE core, right? So we have headline and we have core. The Fed has told us for a long time that PCE core is the number they watch the most. They look at everything, but that's the one, right? And unfortunately, it broke trend. What does that mean? If you look at CPI, you look at PPI, you look at PCE headline, all of those have trended lower. Now they aren't going lower faster, but they're still lower, 6.5 to 6.4. PCE core went up. And I believe that going up, not flat, up, is what has caused rates to explode this week. There's now a generalization by the market, the bond market, the stock market, that rates are going higher for longer. I think it's the fact that PCE core broke trend is why we saw rates go up 0.5 point this week or whatever it's been. PCE core, the Fed's favorite inflation gauge, is no longer trending negative. It popped up, and that's the thing that I think got us this week. And that's what I think's caused this whole market to go, oh shit, this inflation thing's a problem.
Very interesting. We are not through the woods. I feel like that was the theme all of February. I kept saying, we're not through the
Not
woods.
through it yet. Don't pop the champagne yet. Yeah.
Okay. Okay. It's interesting too that, I had described as a head fake, that a lot of people kind of like a lot of realtors and things thought like, oh, we're back to business as usual. And
No.
that was probably a bit of a head fake just based on that little hiccup or that little just
Well,
down
it's a
turn, right?
lesson learned. I mean, I take everything. I don't. I do my best to just be a even keel. And I think what we learned in this is if rates go below 6, the buyer goes bananas, right? They're on the sidelines. And I think we know that. So if in the future, I don't know, late this year, early next year, if rates trend below 6, I think we know what we expect. There's a lot of pent up demand that unlocks sub 6. So lesson learned.
Very interesting. Let's continue. We're going to come back to rates. We'll finish on that. Retail sales. What did you see this week and just your general thoughts on retail sales?
Man, the Jerome Powell's got to be pissed. He's raised rates 400 basis points, probably 500 basis points. He's trying to crush consumer demand, and it's not freaking working. Retail sales for the last month were up 1. I think it was 1.8, might have been 1.7%, but on an inflation adjusted, they were still up 1.1. So real versus nominal, right? Of inflation adjusted, the consumer is still spending is up 1.1%. Now, you could argue, hey, it's on credit cards, it's on this, on that. They're spending. The consumer is spending, and I can't imagine Jerome Powell is very happy with that.
Very interesting. We are not through the woods. We're going to keep an eye on retail sales. Let's talk about jobs. What did you see this week and just general thoughts on jobs coming back?
Yeah, jobs, you see a lot of headlines, a lot of tech headlines. It's certainly going to hurt the Silicon Valley, right? The Bay Area market, but the Bay Area real estate market is tiny in comparison to the country. I think we're seeing a jobs market where it's easy to find a job. We're seeing like real estate agents we talked earlier, right? If you don't want to be a full-time real estate agent, you can stay part-time and go get a day job somewhere else. There's other jobs out there. So I think the job market is strong. I think we get a monster number on next Friday, March 10th, which will be the February jobs number. If that's a barn burner, right? If that's 300, 400,000, we're going to get a 50 basis point March 14th. I don't think it will be. I think we'll get some adjustments lower, but yeah, the jobs number next week's important.
So let's talk about that. That's March the 10th, correct?
Correct. March 10th.
And then we also have the Fed. The Fed meeting would be on March the 14th?
14th. Yeah, I think they meet the 13th and 14th. Yes.
Got it. So potentially, okay. So we really basically in the next 10, 12 days, basically the next week and a half, we're going to have some big indicators, something to watch for.
Huge market movers. Yes.
Okay.
Huge.
Absolutely. So let's continue. Let's talk about consumer debt versus savings. And then I know you've even made mention about credit cards and just what are you seeing in consumer debt and savings?
I read a report, I think it was Wednesday of this week, that shocked me. Roughly a third of Americans, have more credit card debt than they have savings. So what does that mean? That means you have revolving debt at 18, 19, 20% in excess of your savings. That is not good. If you are in a situation where you have revolving debt at 18, 20%, do something to pay that off. Go drive for Uber, get a second, something. This is not an environment where you would want that. And I've lived in a household where credit card debt was above savings, where we had no savings to speak of. One fart in the wind and you are in financial trouble. We still have 3.4% unemployment, so you can get a job. It may not be the one you want, but please protect yourself. And if you're in a situation where credit card debt is in excess of savings, please fix that. Please fix that.
Noted. Take note, listeners. Take note. You at home watching, all of us in the One Rental at a Time community. Thank you, Michael, for sharing that. Let's continue. Let's talk about housing market, existing home sales versus new home sales. I know there's a lot of interest and a lot of like up and down headlines all month about new home sales, what builders are doing. They're not building, they are building. What did you see in new home sales versus existing?
I think new home sales are going to surprise to the upside. I think builders are going to surprise to the ones that are public will surprise to the upside because it's very clear they have figured it out. A, they're building less homes, so they're controlling the supply. B, they have learned that they can just buy down the interest rate instead of giving a big discount. John Burns Real Estate Consulting, just yesterday, I talked about it on the Daily Financial News. They realized that they could either take a 16% discount on price, or they could spend about 8% on points to buy the rate down. Guess which one they're doing? 8% buying down the rate, which, oh, by the way, if you're a home buyer and you plan to live there for 8 or more years, it makes total sense. You want a lower rate. You would want 4.99 instead of 7.2. Do the math. Just do the math. And it's pretty amazing to see how much lower your payment is with a 2% discount on rate. So I think new home sales will surprise to the upside this year, while existing home sales will disappoint at 4 million. So it's wild to look at, because again, what is a home builder? They can take discounts, or they can buy new home or like existing home sales, just mom and dad. They can't do that. They may not have the equity, they may not want to. They have other things. So it's going to be wild to watch the new home sales, I think, surprise to the upside, where existing continues to disappoint.
Very interesting, folks. You heard it here. One rental at a time, daily financial news. Even Michael, I've got to say, even when you were on holiday, when you were on vacation, I love that you kept checking in, kept, putting in the work. Still, you could tell that this is your passion, and sharing with your community, what's going on, and staying informed and staying on top of it. So thank you for all the work you do. I want to finish with a thought. Let's play out a couple of scenarios about, again, we're all in the housing business. We're watching because we're all interested in housing, whether you own a lot of rentals, you're buying your first rental or the next rental, or even buying a home. What are your thoughts? So let's say that, okay, the news is negative on the 10th. Okay. Jobs comes in hot.
Okay.
Now, potentially, we're looking at 50 basis points.
Yep.
Or even 3 increases of 25, 25, 25.
Yep.
What do you see with the 30-year mortgage? Do we get back up to 7 1/4, 7 3/8? What do you see kind of?
Yeah.
What do you
so
see
again,
rates doing?
Yeah, my crystal ball is as broken as anyone else, but I think there's a couple of things. I think for the year, mortgages go between 6.5 and 7. That's where I think they are for the year. Could over the next 30 days rates get to 7.1? Sure, absolutely they could. 7 1/4, maybe. 7.5? I don't think so.
Let me unpack that, though, and here,
sure.
Let me ask why, because I think this is a good question. Is it because the mortgage industry is crystal clear? If they get up in that range, their book is going to go to zero. They're not just basically they're going to put themselves out of business, and they would even potentially even have softer margins potentially for the interweek stuff. Is that
really what I think is, I think the Fed is getting closer to the terminal rate.
Okay.
Right. And they'll be a lot closer to that after March 14th. And banks, AKA lenders, they want the terminal rate, because once they know the floor, they can play with their margin. What we have seen the last time rates got over 7 is nobody knew where terminal rate was, right? We got a new, the dot plot came out, and it was all shocking. It was all scary. And it was like, oh my God, I don't know what's going on. So then banks expanded their margins. I think it's fair to say we're closer to the terminal rate now than before. Logically speaking, that would be true. Could it be 5 1/4? Could it be 5.5? Could it be 5? I think all three of those are possible, but we're closer than not. And then all happens is people play with margins. So if we go to 5.5, which I think is the outside, historically, the average has been 1.7 to 1.8, 170 to 180 basis points. So that brings us to, 7, low 7s. If it's 5 1/4, then we're sub 7. So that's where we're at. So I'm going to guess the terminal rate's 5 to 5.25. And then that would mean rates are under 7, just a tick under 7.
Got it.
That's
okay.
where I'm at.
So stability, we're still going to lose 35, 40% of national sales. Sales are going to be sluggish. A lot of people, low inventory in the markets we've talked about, affordable. First-time buyers are still going to be a tight market looking forward is kind of our thoughts and just that your general.
But I want to be very clear. For the opportunity to me is crystal clear. And I've executed one completely and the other one's listed right now. I will buy every fixer below the median that I could fix up and repair and profit on.
Yep.
If I can produce a turnkey, ready-made, first-time home buyer home profitably, I will do it, and I'll do it every time. So if you're in the Fresno market, you have a junker, reach out to Ty, reach out to me. I'm sure we can put a deal together because the first-time home buyer homes, FHA buyers, they want to buy, and there's just no inventory. So if I can fill that need and take a just total junk slumlord property and spend 50, 60, 80 grand fixing it up, and of course profit from it, I'll buy those all year. So I'm not running away, but I won't touch a luxury flip. No chance. You could offer me a $1.5 million home for like 800 grand that needed 300 in repair, and I wouldn't touch that deal. I wouldn't touch it.
So good. I've been saying that for a long time, man. So good. So good. Folks, there's a lot of opportunity out there, even with seller finance, subject to staying in your buy box. And that's what Michael just described is, not working outside of your buy box, but staying in your buy box. So, Michael, thank you for all that you do and share. I want to just really, my call to action to everybody here is subscribe. Subscribe. If you like the show, if you support the show, please subscribe. Michael keeps putting out great content. Michael, thank you. Welcome back. Thank you for all that you do.
Thanks, buddy.